and welcome to LSBF TV for AAT students worldwide. My name is Paul Marrison. I'm an experienced tutor here at LSBF, and I'm going to be doing session 1 out of the 10 sessions we're going to have, 1 a week for the next 10 weeks, of the business tax module for level 4. During those 10 weeks, we'll be going through pretty much all of the tasks of one of the AAT's sample assessments, aimed at helping you to understand where the difficulties are, how you can make your life a lot easier, and make sure that you have success when you do this thing for real. We're going to be working on task number 1 today, so let's have a think about what the AAT are looking at within task 1 of business tax. So, what is within that first task? Within this task, we look at the calculation of taxable profits, and that means we are going to be looking at allowables and disallowables. So, which items of revenue are going to be put through this calculation and which are not? And in a similar way for expenses, which items stay in the calculation and which items have to be removed. Now, that stuff is not too difficult. The bit which is going to potentially cause a bit more trouble, and therefore we're going to have to take nice and slowly and make sure you have practiced loads before you sit this thing for real, are basis periods, and linked in with that, overlap profits. So the basic situation we have here is this. You are putting together your financial statements, your accounts if you like, and those will be for a given accounting year end. But the taxman or taxwoman doesn't deal in accounting year ends, they deal in tax year ends. And basically every single tax year that runs from the 6th of April through to the following 5th of April, for every tax year you're going to be taxed on something. The basis periods thing that we'll be looking at a little bit later on is all about working out which accounting year or which part of an accounting year is going to be taxed in any given tax year. Now, I never like to describe something as difficult because that's not very motivating, is it? What we want to hear is, it's easy. The great news about this particular paper is that when you do an assessment, up on the right hand side of the screen is going to appear some reference material. It'll be a series of bullet points with the titles of each section of reference material that you're provided with. And the great news is that throughout this assessment, not just this week, but all of the 10 weeks, we can use the information in that reference material to help us answer the questions. And let's face it, that's very, very helpful information, isn't it? Because if there's stuff in the exam that can actually help us, then even if we can't quite remember the stuff we've studied, there's a reasonable chance that the reference material is going to be our get out of jail free card. Okay, so let's get going. I should stress before we start looking at the task that when you do these assessments for real, you'll be doing them on a computer screen, and when you click on the boxes that you have to fill in, often a drop-down menu will appear and you'll be selecting an item For the purpose of these TV shows, we're not going to be doing the actual assessment on the AAT's website. We're going to be doing it pen and screen. So I'll be writing things down and writing things in, when in reality you may well be selecting them from a menu. So just bear that thought in mind. I should also say, before we get going on this, please go and practice the sample assessments to get used to the process. But maybe more importantly, when you practice the sample assessments, that reference material I just mentioned comes up. Go and have a good look at it and make sure you know what is in there, and I suppose what isn't, so you can make the best use of it when you sit this thing for real. Okay, let's get going then and make this a fun Friday. So if we head back up to the top, and we can see Business Tax Practice Assessment, and here we have a task number 1. Now in this task, you are going to be asked to look at a series of items that you can see on the left-hand side of the screen. There are 6 of them in total, and you've got to decide whether these items in the tax computation are going to be disallowed and deducted. Now think about that. You can only deduct something which is in there in the first place, or disallowed and add it back, or it's an allowable item. Now, to deduct something, it needs to be a positive in there. In other words, revenue. When you are adding something back, you're adding something back that has been deducted in profit. In other words, an expense. Okay, now some good news about this. There are 6 items down the left-hand side there. We'll start at the top. But the rules on allowable and disallowables are in the reference material. Not to as much of a degree of detail as you would want them, but some of these answers you can simply look up in the reference material on the day you do the assessment. So let's begin. Now, as I said, when you do this for real, it will be on the computer, and you will click these boxes. Clicking a pair, one on the left, one on the right, will get a line to join them. I'm going to go old school today and use a pen and join them up. So let's start with a general provision for irrecoverable debts and expense in your profit or loss in your financial statements. Is that an allowable deduction? Well, no, it is not. You can only allow for specific provisions for irrecoverable debts. General is too vague. If these were allowable, companies could reduce their tax bill by simply being incredibly pessimistic and saying, oh, 80% of our sales will never pay us. And that would be seen as a manner to defer and delay paying tax that really should have been paid. So that one is going to be disallowed and added back because it's been deducted, because it's an expense. So knock it out and add it back. Second one, donation of £1,000 to a political party. Well, a donation to a political party, if you look it up in the reference material, tells you that donations to political parties are never allowable. So that one is going to have to be added back as well. The third one is also in the reference material. You are spending some money making your customers very happy by giving them a bottle of whiskey. Nice! Why do my customers never give this to me? So are these costs allowable? Well, there are rules about this, and if it is genuinely for business purposes only, it may well be allowable, but there are some excluded items. If you put the company logo on it, that helps to make it allowable. if it is less than £50 per item, that makes it allowable. However, if you read the reference material, all the nice things, food, drink and ciggies, are disallowed. Boo! So that one is another disallow and add back. It was so close to being allowable, but no, it ain't. Fourth one, gain on sale of shares. And the sixth one, the profit on sale of lorry. Well, both of those are income that will be taxed, but not through this system. So these two will both have to be deducted from profit. They'll be taxed elsewhere. Which leaves us with number 5. This is a classic tax issue. A big thing with tax and allowable expenses is the expenditure improvements, capital, getting new assets, or is it repairs to existing ones? And a repair to your factory floor, because it's repair, it's not a capital item, it's not an improvement, that one is going to be allowable. So there we go, first task done. A lot of the items in there, if you take a look at the reference material, it either tells you explicitly what the rule is, or it gives you a fairly big hint. So there's the first bit of the task done, nice and gentle. And then we get on to the second bit. Now this is going to be tougher. If you look at the examiner's comments for task 1 on this business tax paper, this is where things can get a little bit complicated. But I have some fabulous news for you. This one is all about basis periods, but within the reference material there is a very, very helpful flowchart, and if you just follow the flowchart through carefully, it will tell you what you need to do. Okay. So let's have a look then. How does this work? So, you start trading. And after you've started trading, you will come up to your first 5th of April, the end of a tax year. And at the end of that first tax year, you will be taxed from the start of your trading through to that 5th of April date. So that's what happens in year 1. Then the second tax year happens. And the taxman wants some more money from you. What happens in year 2 is where it gets a bit complicated. If you have an accounting year that ends in the tax year, if the accounting year is 12 months long, then the basis period, in other words, what you'll be taxed on, will simply be the accounting year. Now, one thing to note here is you are going to be based having tax on a 12-month period now because you're up and running. When you start off, fine, but in this second year you're going to be taxed on 12 months of something. The fun starts if your accounting year is not 12 months. Because if your accounting year is less than a year, and they want to tax you on 12 months, then you will be taxed on the first 12 months of your trade. Which is a bit annoying when you think about it. Because you've been taxed from the start of your trade up till the 5th of April already in tax year number 1. You're being taxed twice for the same time period. Now all of this will get resolved in the future, otherwise that would be unfair, wouldn't it, being taxed twice on the same amounts, but for now you're stuck with it. If your accounting year is greater than 12 months, then your basis period is going to be the last 12 months of the accounting year. If you have no accounting year end in this second tax year, well, it would be lovely to think you're not going to have to pay any tax at all. Ha ha ha. That's fairly never going to be the answer, is it? What happens now? You will be taxed for 12 months of the tax year. In other words, from the 6th of April to the 5th of April, you are taxed for the 12 months profits you've made in that tax year. And then we can look at this answer in the third tax year. What happens then? Well, now stuff should be sorting itself out, and you are going to be taxed for the accounting year that ends in that tax year. Or, if it's not a 12-month period, the last 12 months to the accounting year end in that tax year. Now, I think this is fiddly. There's a lot of stuff you learn in your studies where you can understand the logic behind it, and that helps to get it in your head. I think this is one of those things that is best memorized, practiced, but please don't forget in the reference material that you have with you in the exam, make sure you know where this is. There is a flow chart, just take it through slowly and you will be fine. Right, so with all of that in hand, we can now go and take a look at what the actual question says. It says Meredith started trading on the 1st of February 2015, making up her first set of accounts for the 15-month period, so more than 12 months, to the 30th of April 2016. And then we've got her trading profits for 15 months there. And then we've been given her trading profits for the next accounting year for 12 months there. Right, show the taxable profits for the second and third tax years. Complete the dates for the basis periods. Enter the earlier taxable year first. But for a bit of extra practice, we are going to do all three of the first 3 tax years. We only have to do 2 and 3 for the assessment. But let's come down here and use our rules. Well, the first tax year is going to be tax year 2014-2015. So in other words, the 6th of April 2014 to the 5th of April 2015, because she starts her trade within that 12-month period. What will she be taxed on? Well, you remember the rules. In year 1, you're taxed from the start of trading up until the 5th of April. So she will be taxed from, when did she start trade? The 1st of February 15's profits up until the 5th of April 15. Now that's tax year 1, not needed for the answer, but it's good to do it because it tells you that tax year 2 is therefore 2015-2016. So up to our box we go. And that of course means the 3rd tax year will be 16-17. Right, basis periods. Let's go down to the rules. 2nd year. Does she have an accounting year ending in the tax year? Well, the accounting year ends the 30th of April 2016. That is after the 5th of April. So the answer is no, it does not. So we have to come down here. There is no accounting year ending in that tax year, so she will be taxed from the 6th of April to the 5th of April of that tax year. So 6th of the 4th 2015 to the 5th of April 2016. How much is that going to be? Well, that period there is 12/15ths of her 15-month accounting period. Whoops, when she made a profit of 94,920. And then in tax year number 3, 2016-2017, what happens then? You are taxed for the accounting year that ends in that tax year, or the last 12 months to the accounting year end in that tax year. It's not a 12-month period, it's 15, so she is taxed for the last 12 months of the accounting year. Her accounting year ends on the 30th of April 2016, that means the 1st of May 2015. And what is that calculation? Well, again, it's a 12-month period, and all 12 months are from the accounting year. So it's 12/15ths again. It's the same number. What is that number? Let's get a calculator on it. That is 75,936. So up we go. 75,936. A different 12 months of the 15, but it's still 12/15ths, so it's again 75,936. And then the final part of the exercise is on overlap profits. As I said before, the problem you've got here is because the rules and the way they are, you end up potentially being taxed on the same months twice. And if we come down here and look at what she's been taxed on, year 2 was the 6th of April 15 to the 5th of April 16. Year 3 is the 1st of May 15 through to the 30th of April 16. So the bit from the 1st of May through to the 5th of April 16 has been taxed twice. Now we deal in month ends, don't worry about the 5 days at the start of April. And that is May through to the year end, which is 8 months, plus 3 months up to the end of March. That is 8 plus 3, that is 11 months taxed twice. So take 11/15ths of that profit and you get 69,608. And there you go, folks. We have done it. So, there is our first week's task done. Thank you very much for watching. Please make sure you have a look at basis periods and the overlap profits that they create. But I think the most important thing from this week that I have to say to you is go and practice the sample assessments on the AAT's website, but go and take some time looking at that reference material that appears in blue down the right hand side of your screen. Click on the links, look at what is in there so that you can find it quickly when you do the actual assessment itself. Do tune in again next week for the second one of these shows when we'll look at task number 2. If you're doing personal tax, in a few minutes time I'll be doing that one as well. Thank you, best of luck with your studies, and I'll see you again soon.